Well, to go more in depth on the bank earnings and what is moving markets, I'm joined now by David Wright, president and owner of Wright Financial Group. David, it's good to have you on the show here. And what do you make of the market action?
Not a surprise. The larger banks right now are, maintaining and actually exceeding Wall Street estimates. I think all three of the banks you mentioned, J.P. Morgan and Wells Fargo and Citigroup have all basically overachieved. And it's just due to scale. The larger commercial banks, they're not on the same playing field as the smaller regional banks. They have more ways to earn interest, more fees they can charge. J.P. Morgan's Jamie Dimon, however, is probably one of the more bearish CEOs out there, is predicting some, troubled seas ahead for even larger banks as we move down the spectrum of the fact that the Federal Reserve at this point has maintained their rate hold for the moment. And I think that's going to impact large banks, but also going to be impacting down the road regionals even more as we have lots of commercial loans coming due this year in 2024. Those large commercial loans have to be renegotiated. And I think at that point, we're going to be seeing a lot more volatility and activity in the banking sector.
Interesting. So with the recent inflation reports this week, which I should note, really honestly, were not drastically out of expectations. I think probably more so than anything, they did show that inflation is still around and added to comments that we've heard the past 2 weeks from federal officials, federal bank officials, that the rate expectations might be dialed back. And so based on what we've learned the past 2 weeks or so, and even what we learned from the banks today, do you think the direction of the stock market changes, that some of these recent gains could be dialed back?
I do. If you look at what the Wall Street predictions were for June's rate cut, they've dropped by 74%. There's actually a 17% chance of any kind of a rate cut Wall Street's predicting in June. And I think that's going to continue to play its way out throughout the rest of the year. The question is, the feds have the lever. They play both the arsonist as well as the fireman. They're able to put out the fire by cutting rates. But with inflation, core CPI just being reported in at 3.8% gives them pause. They're going to say, you know what, if we cut rates, is that going to increase that inflation rate even further? Yet if they continue to hold rates, that's going to put continued stresses on regional banks. So I think you're going to see, it's a mixed bag. We could see a market that's basically continuing, I think in the middle part of the year, kind of flat. Maybe at the end of the year with the election looming, perhaps the feds go political and in this thing, rate cuts occur at that point, and that refuels the market at the end of the year. I think the market would probably benefit from a pullback of 2 to 10% to allow people to kind of pause and maybe get back in at the bottom of the market. So right now, all bets are off the table, what the feds are going to do. But most of the Fed governors are, it's a mixed bag between holding. A couple of them are even mentioning raising rates perhaps in the final 2 quarters of the year. So it's anybody's guess, Kristen. We just don't know where it's going to lead to right now.
Walk me through more of what you're watching in the banking sector, David, because it was just a little over a year ago that we saw several bank failures. Banks obviously still challenged, and even J.P. Morgan earlier this morning, it sounds like saying that its net interest income expectations have been dialed back.
Well, if J.P. Morgan's saying that and Jamie Dimon, then take that times 5 when it relates to the regional bank crisis, because they don't have the capacity to do investment banking globally like J.P. Morgan, the largest bank in the United States, has. And these regional banks have been sitting on shrunk net interest income for a long time. And it's getting to be more stressed because of the fact that there's dialed back loan activity. There's more foreclosures that are occurring. And not to mention the fact that They're holding all these low interest rate loans on the books, and more consumers, and I see that even in our practice, that hold money at some of the larger banks like a JP Morgan. They're even becoming a lot more intelligent, and they're starting to say, you know what? Why have I been sitting in this lower interest rate savings account for so long when there's something over here I could be getting for 4.5 or 5%? So that's cutting into the bank's profits as well, because that difference between what they loan out and what they get back in, what they have to pay out to depositors, that shrinks those margins when the consumer gets a little bit more intelligent about their savings account. So all of that, the regional bank, the KRX regional bank index will be reporting next week. We'll take a look at some of these regionals, but I expect there to be more pressures there with the smaller regional banks.
Interesting. So for our viewers watching at home, David, I want you to explain this somewhat of a conundrum, right? That the economy, by many measures, seems to be good in corporate America, by and large, banks aside, right? They're buying back stock, they're issuing dividends, we're expected to see earnings growth. The economy looks good. But yet the stock market is down. And oftentimes, we know, yes, the stock market or investors can take a 6-month forward-looking outlook. But how do you explain to a viewer that even though the economy is strong, the outlook for rates can still have a downbeat impact on equities?
I think the reasoning for that is, again, you have to point back to the Federal Reserve. They're the brunt of all this problem. During COVID, when we shut the economy down, so much money was printed, 1.9 trillion, and with the lowering of interest rates for a while before they had to hike, that just injected so much liquid rocket fuel into the market, and we're still seeing the effects of that. Corporations still have some cash in their hands that allows some institutions to do more investment, mergers and acquisitions. But I think the well is starting to run dry on that. And that's why I think inflation is remaining sticky right now, because we see oil prices starting to increase, towards $90 a barrel. All of those things trickle into the cost of consumer goods. And so the middle American is the one that's getting left behind here, Kristen. The people that have 401ks, IRA accounts, those accounts are benefiting from this pretty nice first quarter in the stock market. But looming ahead, we have increased 1.13 trillion credit card deficits that are growing for middle America, more people foreclosing on their houses. I think that's going to trickle down to the stock market at some point and affect this gap between the very, very wealthy in the country and just middle Americans that are living paycheck to paycheck. One other thing I want to mention is the jobs report. The jobs report comes out, and we're still holding strong at about 3.8 unemployment. But those jobs, a lot of those jobs that are being reported on are, basically gig types of jobs, part-time jobs. They come in, they leave, and a lot of them being maybe taken from people that are migrants that are coming over the border. So it's a situation where we're right now looking at the market being very much up in the air as to what's going to happen down the road.
If we do see a pullback, David, what would you anticipate? I mean, do you foresee a recession on the horizon, which could see a drop of, let's say, 20% roughly in stocks? Or are we looking at more of maybe just what would be a normal correction of about 10%?
Well, I think there's going to be more of a normal recession, probably of 10%, maybe a little bit more, between 10 and 15%. Because again, as I said earlier, the Feds are both the arsonist by creating more capital and reduced rates. They've got the lever of lowering interest rates. So they can kind of be the firemen here and cool off if markets start to fall into recession. But I think the other issue is, the Feds do have another lever, and they could institute quantitative easing again. Now, God forbid they start printing capital or at least stop taking money off the balance sheet like they have been doing the last several months. But I don't see the market pulling back 15 or 20%. I would see a recession of perhaps 8 to 10% by the fourth quarter of this year, and then people waiting to find out, what's going on with the election. And I think some of those same sentiments are showing up in these consumer sentiment surveys, the University of Michigan one being the most recent one.
All right, David Wright, we got to leave it there. Great to get your take. A lot of market moving action these past few weeks. David's the president and owner of Wright Financial Group.